Okay, accounting students, this is part 2 of our chapter 1 video lecture, where we're going to be learning about the accounting equation and how to use it to record business transactions. First, the accounting equation is assets are equal to liabilities plus the company's equity. Assets are things that the company owns, and liabilities are the amounts the company owes to other people. And equity is just the owner's interest, in our case, the stockholder's interest in the company. So everything that the company owns is equal to what we owe other people plus what the owner gets if we were to pay off all the liabilities with all the assets. And this equity section, we'll have a whole chapter at the end of the semester to analyze, to break down this equity section. But for now, we're going to say equity has two parts. The money put in by the owner, called capital contribution, or we're going to keep track of the amount put in a category called common stock. And this retained earnings are all the profits the company has earned since its inception and minusing out any profits we pay back to the owner. Here's how we calculate profit or net income. We look at the revenue the company earns and minus out the expenses the company incurs. Again, that difference is called net profit or net income. And then if the company keeps this profits, this retained earnings will get bigger and bigger. But eventually the owner wants to share in those profits. So we're going to pay out dividends to the shareholders. Again, here's money coming in from the shareholders to the company. And here's money going out from the company back to the shareholder called dividends. Now, each different type of asset the company owns is going to be tracked in a category called an account. Yeah. Again, an account. So one account for assets would be cash, the money that the company has in its bank account or in the cash register or in the safe. Another type of asset that has value is the money owed to us by other companies or other customers, called accounts receivable, or the equipment the company owns. All of these things have value. All of these things are going to be used up in the future or converted into cash now or in the future. Again, those are assets. And each type of assets has one account: a cash account, an accounts receivable account, equipment account, building account, land account. Now, in the case of liabilities, we have different types of liabilities. One of the main ones is called accounts payable. So any general creditor we owe money to, for example, a vendor, a supplier we buy from that we still owe money to, will go into this account called accounts payable. Or if you have a mortgage you pay to the bank, maybe you have something called a note or a mortgage payable. The key word here for liability is the word payable. Whenever you see that word, that's indicating the account you're dealing with is a liability type. And then the equity, again, we're going to have that common stock account and revenue account, expense accounts, dividends is an account. Okay? Now, when we have a transaction, we're going to plug the numbers into this equation. And like the equal sign shows here, whatever is on the left side has to equal on the right side. So let's take a look at some transactions and fill it in this accounting equation format. So here's our first transaction. Chase forms a new business, a consulting business called FastForward. It's a corporation. Again, that's the type we're studying, the business entity. So the first transaction typically is money coming into the corporation because it needs some type of working capital to get things moving. So Taylor, our owner, our shareholder, is taking money out of his own personal account, bank account, and depositing it into a new bank account under the name of the business, here in the amount of $30,000. So this is one transaction, transaction number one. And now what we need to do first is to identify the different accounts that are changing. And there's only two things you do to an account. Either make it bigger, increasing, adding, or you make it smaller, decreasing or subtracting. Okay, so we identify the two accounts here. The money account, cash, is increasing. Cash is that asset type. And the other account that has to change, again, there has to be at least two accounts changing, is that common stock account, because this money is coming from the shareholder. Okay, so that's why we have to increase or credit this common stock account. So plugging the numbers into the accounting equation, what we see, here's that accounting equation, and under that you can see the different accounts: cash asset, supply asset account, equipment account. Here we're going to increase cash by 30,000. It was zero, but now here the leftover called the balance is 30,000. Nothing yet for supplies and equipment asset. Nothing for liability accounts. But under equity, the common stock was zero. Now it's increasing to 30,000. So when we take grand totals here at the bottom, you can see on the left side, total assets, 30,000, have to equal liabilities plus equity of 30,000. If at any point it doesn't equal, that's indication that something's recorded incorrectly. And even if it does equal each other, the so-called balance, left and right side, there still may be a problem. For example, if you put this 30,000 here under this account for notes payable, that would be a mistake. But the 30,000 here would equal the 30,000 on the right, even though it's a mistake. Yeah, definitely have a mistake if the grand totals down here don't match. But there still may be a mistake if you had misclassified, recording the amount in the wrong column or in the wrong account. Okay, let's take a look at the second transaction. Here we're going to purchase supplies, and right away we're going to pay cash to that supplier in the amount of $2,500. So right away, whenever you have a transaction, you got to identify what accounts are changing, be they increasing or decreasing. So here's the two accounts we identify. We're spending money. Cash now is going to go down, decrease, minus. But now we have a new asset, supplies we're buying. So all we're doing is exchanging assets for the same dollar amount. But let's plug that into our accounting equation. This line one, it was the previous balance. So here in line two, now spending money, 2,500 minus. So now the leftover balance here at the bottom is now 27,500 in cash. Supplies were zero, but now supply balance is 2,500. If you add up both assets, here's the total assets after the two transactions. And it should equal the same 30,000 we had from the previous transaction. Again, zero liability balances plus 30,000 common stock or equity balance. Let's take a look at transaction number 3, where we spend some more cash, this time not buying supplies, but buying equipment worth 26,000. Again, right away, you got to identify what accounts are changing. In any single transaction, at least two, maybe even more accounts have to change. But the accounting equation always has to stay in balance. Left equals right side after recording it. So again, cash goes down, minus, and a new asset, equipment, goes up by the same amount. Cash goes down. You notice we're starting to run out of money. Balance of 1,500. Supplies stay the same. Equipment has gone up. It was zero. Now it's 26,000. If you add up all three asset balances, the total is still that same 30,000 we started off with. Again, no change to liabilities plus the same 30,000 equity. So the left equals the right side here of the accounting equation. Transaction number 4, we're going to buy some more supplies, but this time we're not going to pay right away. Here you see the term on credit, or sometimes you'll hear the term on account. That means we do the transaction, but we don't pay the cash or receive the cash right away. It's going to be handled later on, the cash payment or the cash receipt. But you still got to record the transaction right now when it took place. So again, you identify the two accounts that are changing. Here's more supplies being increased. But the second account changing is not cash. Here we owe the money. Owing money is a liability. And the name of the liability account we're going to use is this general one called Accounts Payable. Again, whenever you see the word payable, that's pretty much telling you that's a liability type account. And here you're going to be owing more money, increasing. So plugging in the amounts into our accounting equation, suppliers are going to go up. Now you have a balance of 9,700 supplies. You're not spending the cash, but you're borrowing the money from that supplier, increasing the liability, specifically the account called Accounts Payable. You see the word accounts with the S. That means you could have multiple suppliers or vendors you owe money to. Each one of those people you borrow money from is one account. And we would total up all of the accounts we owe them and call that total accounts payable. Okay, 7,100 now for liabilities, plus the same equity. So here's the total on the right side of the equal sign. And again, now when you add up the three balances of the assets, the total should be the same. Has to match. Otherwise, something was recorded in this last transaction if you're balancing before that. Let's look at number 5. Now we're going to do the real work. We're providing consultation services to our clients. And right away, we got the money. Again, we gave them the bill and they gave us the check or the cash right away. So here's the cash coming in. And now we have to record the second account changing. In this case, the account is called revenue, or the type of account is called revenue. The name of the account itself is probably called consulting fees or consulting service fees. Okay, that's the name of the account. Revenue is really a type of account. Okay, so we got the two accounts changing. Now, when we plug it into the accounting equation, cash is going to go up here on the left side of the accounting equation. And on the right side, we're not owing anybody money. The owner didn't put money in common stock, but here we earn the money. Again, that's called revenue. Consulting fee service is probably the name of the revenue account, which is not listed here. So we add up all this right side to get this total, and it should equal the left side total, yeah? So we're in balance. Equation number, transaction number 6 and 7, we have two things happening here being recorded at the same time. Whenever you see the word paid, that's an indication cash is going to go down. And why is it going to go down? That's the other change in the accounting equation. In this case, we're spending $1,000 for rent and another $700 for employee salaries. Both of these two amounts are costs being used up, and that's going to be classified. Used up cost is our expenses. So cash goes down and rent really goes up, right? It was zero before, now rent goes up. But at the same time, if we look at the accounting equation, the right side of the accounting equation is going to go down because this rent expenses are subtracted from the right side. And also the other decrease to cash was caused by salaries being paid, salary expense increasing. At the same time, when expenses increase, equity goes down. So looking at the accounting equation, here in transaction 6, cash goes down. You're not buying another asset. You're not paying back liabilities. You're not getting money or paying back the owner. But here, you're paying off rent expense. And notice it's being entered as a negative number. Rent expense is really getting bigger, but because you should see, let's put it in here. You see a minus here. That has to be subtracted on the equity side here. And then the other cash spent is the $700, reducing your cash balance to $4,000 here at the bottom. And then the other side is expense getting bigger. But because it's negative, you're subtracting it here from the right side on the equity. Equity is getting smaller. So now when you add up the 30,000, you add the 4,200, you minus 1,700 expenses. That total of these three is the total equity. And you add that to the liabilities of 7,100 to get this total on the right side of the equal sign. And cash went down, balance here of 4,000, plus the supplies, plus the equipment gives you this total assets we have. In a future chapter, we'll see how this supplies is going to be reduced, adjusted as we use up the supplies. Same thing with equipment. When we use it up called depreciation, we'll see how this amount gets decreased. But for now, we're keeping it the same. And we're in balance here after transaction 7. Let's look at number 8. Now we're going to provide more services to our customer and give them the bill. When we do the work and finish it, we're going to give them the bill. And now we're going to report the money being earned right away. That's called revenue. Specifically for consulting fees, that's 1,600, and also subleasing, I guess, part of our property to a customer for $300. That's called rental revenue. Two different ways of making money here, both being increased. But the thing is, when we gave them the bill for these two charges, we didn't get the money right away. But we got to record it now because the work is done. We got to report the revenue or recognize the revenue. So instead of increasing cash, we have the right to receive the money, the cash. That's an account called accounts receivable asset being increased. So let's take a look at that entry here. Here, not cash, but the right to receive cash from our customers called accounts receivable. Again, you see the plural here, accounts. Each account, each customer that owes us money is an account. And we group that all together to get accounts receivable total from all our customers. They owe us $1,900. And the reason why is because we earned the revenue from them, from consulting, from renting out, subleasing part of our office space or property. Okay, so now you can see, added up all this revenue here. Keep in mind, revenue is a type of account. And there's two revenue accounts, one called consulting fees and another called, I believe, rent income or rent fees. Okay, so we add up all the right side, keeping in mind this is negative, so we minus this out to get this total. And then add up all four assets now, including the new accounts receivable asset, to get total assets balancing with liabilities and equity. Transaction number 8. Transaction 8, okay, 9. Here we have, again, money being collected from that customer who owes us that money, the $1,900. So here is the money coming in, increasing cash. The thing is, you don't count the money as revenue again because it's already here, this $1,900. So what you got to do as a second change for this transaction is to reduce the accounts receivable asset. Now the customer owes you nothing because they paid you back that $1,900. This by itself, collecting the money, is a separate transaction recorded separately from the previous entry here when you recorded the revenue and recorded the right to receive the money. And again, reducing the right to receive the money because here's the money coming in. Add up all your three assets and total. Add up liabilities and equity, again minusing this expense and total. Transaction 10, if you remember we had bought those supplies a while ago and didn't pay our bill, so we owed $900. Well, now we're going to pay off that $900. Again, you identify the accounts you're going to be changing. One is, of course, cash going down, and the other is not supplies. That was already recorded when you first bought the supplies. Here you owe less money now, less liability, so we got to reduce the liability. Reduce the cash, no change to supplies. That $900 of supplies is already built into this balance here from a previous transaction. Here we're going to reduce the amount of accounts payable we owe, reducing liabilities. So in these transactions, both the left and the right side went down by $900. Transaction 11. This is our last transaction for this chapter, this lecture. So we're going to pay back the owner some profits we've been earning in our business. And that type of paying back of profits is called dividends being paid to the shareholder. So here's the cash going down. And we have an account just to keep track of how much is being paid to the owner called dividends. Dividends are not an expense. Yeah, dividends is just like the opposite of that common stock or money being paid in, the paid in capital. Okay? So here's the two changes. Cash goes down, so we end up with $4,800 for the month. No other asset change, no other liability change, no revenue, no expense for this transaction. But here, we're keeping track again of how much is being paid back to the owner who owns this stock. You notice we don't reduce common stock, yeah? We keep track of dividends in its separate account. And it's just like an expense where we use it as a negative number. Again, dividends are not expenses. It's its own separate account here. And if dividends go up, this equity, because of this negative, equity will go down. So here's our grand totals at the end of the month. So based upon the balances you see here in this row, what we're going to do is rearrange them in a financial report, a financial statement, so we can share that with people who are interested in our company. So if you look at now all the transactions here, each of the numbered transactions go across the rows here. And after each transaction, typically you have a balance of what's left over in your accounts. In other words, at the end of the month, our company has $4,800 in its bank account. We have $9,600 of supplies. Again, we're probably going to adjust this, reduce it for the amount of supplies we use up during the month in a coming chapter. We have $26,000 of equipment. If you add up all of these three accounts here, that's the total assets we have at the end of the month. Also, at the end of the month, we owe creditors, the suppliers, $6,200 worth of accounts payable. Here's our owner's interest in common stock. We paid them $200 of dividends during the month. The company has earned revenue of $6,100. Again, keep in mind there's two types of revenues here. That's the consulting fees and then the rent income. And then here's the total expenses. That's the salaries and the rent. Yeah. Okay. So based upon this last row, in the next video, we're going to prepare financial reports called financial statements.